Welcome, everyone. I appreciate you tuning in for a quick market update as we get to the fall here of 2025. We are going to cover a number of items. We'll talk about interest rates, talk about inflation, talk about the big market rally and where we think it goes into 2025, as well as what could happen here in the near term. And of course, tariffs have to be part of the conversation. But before we get too far, of course, the disclaimer has to be put on the screen. You can see it there, big and bold, all the different details. Our lawyers make sure we list that before every video. And I already mentioned some of the topics here, what we went through. Now let me just clarify what happened. So we are going to talk about all of these items and give you a projection, what we think is on the horizon. But 2025 has been quite the year, very resilient for markets. You have the tariff issue, we call it the tariff tantrum in March and April, which impacted pretty much markets around the world, although the US stock market seemed to be the hardest hit in the spring. Every other month so far in 2025 has been positive, and you are seeing a global rally here, Kevin. It's not just one market or a couple of stocks. It really is broad-based, this rally, and we'll go through some of the charts to visualize that rally.
Yeah, and then we start taking a look at it. Let's start with the TSX S&P composite, and what we'll see here is that, based on the chart where it is, we're near all-time highs, if not at all-time highs. And of course, this chart goes back from 2018. So if we take a look at how things have gone, 2018 had a slow end to the end of the year and then bounced back in 19. We had, of course, the pandemic in 2020 and a large recovery through there. 2022, of course, showed us again that we had that sort of slowdown in everything. It was the equities as well as bonds. And we had the recovery in 23 and 24. And again, here's the big factor where we go to 25. Everything seemed to be doing okay. And then you had the tariff announcement that came out. And right there, it goes all the way down. Of course, then you get the pause on the tariffs and markets hitting sort of a new high. And that's just the S&P composite. If we take a look at the S&P 500, it's a larger drawdown that we see. It's the same sort of charting that we had as the S&P. But if we take a look further down that line, it was a little bit stronger drawdown in April than we had on the S&P. But we've also had a stronger recovery. And again, we're back at those all-time near those all-time highs that we're talking about. Now, again, the biggest factor for these two markets to look at is this is not just concentrated. So it's not just the Magnificent Seven tech stocks that are driving the market. S&P 500, it's the breadth. So the breadth of the market is really showing us that it is the entire economy that's moving up in both Canada and the US. And that's a big factor. Again, a lot of this happened after the tariff announcement came out in April. There was a bit of a reprieve. The reprieve has allowed us to get those gains. And if we take a look at this one, this is the world stock market without the US in there. So again, same sort of scenario. We had a little bit more of a different scenario in 2022. But again, there's that April point where it goes all the way down. And again, the world markets are setting another high. So what we're seeing is that since that tariff announcement, we've had some negotiation. It's not as severe as we thought because you're starting to get some tariffs coming through. You had the pause. Things are working out a little bit better going forward. So again, these are sort of the areas that we've seen. So it's not been as dramatic as it has thought at April's timeframe, but we're getting more and more to that all-time high market, and we're still getting the economies to move forward.
Yeah, and again, the key there, the stock market, it's not just one market, not just one area. We're not just saying, oh, Germany's doing really well. It's across the board. European markets are doing well. International markets broadly are doing well. US, Canada, that broad-based kind of rally is quite strong. And as you mentioned, there is breadth within the market. It's not just a couple of stocks going up. It is a rally supported by numerous sectors, numerous stocks. All of that is positive when you have uptrends with broad breadth, and then continuing that kind of conversation. This dives into some of the earnings estimates. So looking at fundamentals here in the US market, and really gets to that exact same question is, oh, it's just a couple of stocks going up. No, is the answer. It is a broad-based rally. And on the screen here, this comes from the compound. They're looking at the Magnificent Sevens, the big 7 tech stocks in the US. You likely know the names. That's the NVIDIAs and Microsofts of the world. And this part of the chart, which I'm zooming in here, is the gray zone. They're saying the forward expectations of earnings from those companies. They still expect them to grow. They expect them to get double-digit growth. So they're stabilizing, not as high growth as in the past. But then if you look at the 493, so if you have 500 in the S&P 500 index, big 7 is the one people keep talking about, stabilizing. The 493 actually accelerating. People expect additional earnings growth from those companies. That's strong. That means it's not just a couple of companies making money and stocks going up. It's a broad base of companies making money supporting the stock market growth. So there's a fundamental underpinning there to the stock market rally. That is very positive. That all tends to speak to longer term uptrends, to longer term bull markets, which we believe we're in. So that is a positive story. When we talk near term, we're saying, all right, what might happen for the next couple of months? We do think we could see a pause in the next few months. That doesn't undercut the longer term rally. It just means in these long term rallies, you get these little pullbacks, you get these little pauses. I think that's what could be next. We mentioned that for a few reasons here. We could likely see rate cuts from the central banks when the markets are at all-time highs. We had very strong gains since April. Normally get a pause after some strong gains, some digestion, and all of that is happening near a seasonally weak time in the markets. You have a few reasons that all kind of point to maybe some near-term digestion as part of a longer-term bull market, but we'll explain these items here in a little more detail.
Yeah, as Clint just mentioned, sort of that's that seasonality time frame that we're dealing with, as well as the possibility of rate cuts coming up. And of course, one question we always get is, well, should we be investing now? We're at all-time highs on the markets, whether it's in the US, Canada, or it's globally. We're getting these big numbers. Maybe I should wait. There's going to be a pullback. It'll give me a great chance to get back in. And, I don't know how long that'll be. And then we can go from there. That may not be the best cases as we've seen beforehand. So when markets have traded at all-time highs beforehand that we've seen, if the Fed starts cutting, or if you're getting central banks to start cutting, the next month or so usually could be choppy. And again, where we are right now in seasonality, I would expect that would have a downward effect on it as well. But as we see in the next 3 to 6 months, most markets tend to go positive again. There are a few instances where that hasn't happened. But the big factor on taking a look at this is looking 1 year out. 1 year out, every time we were at an all-time high and rate cuts happened, a year out, there were positive returns. And that is a big factor to take a look at, is those positive returns that you're getting. So even though you're at an all-time high, it doesn't mean that we're in a problem or that you should be waiting all that time to not buy before you cut back. We continue to believe that the market going forward is going to have that sort of a scenario. As we say, near term, we do believe it's choppy because you are going to get rate cuts. You are probably going to find out that that traditionally in our historic time where seasonality plays a part, that September, October timeframe where markets tend to come down, may be something that we don't want to look at. But again, it's not going to be dramatic. And then 6 to 12 months out, we are definitely going with that higher probability of gains based on historic trends, as well as what we've seen for earnings going forward.
Yeah, so again, the underlying bull market trend very much intact. All the positives we mentioned earlier. This just points to near term. You talked about rate cuts near all-time highs. I'm going to mention the big gains that we saw since April, and I'll make this larger because there's lots of data here. Effectively, in the past, we've seen these green lines. Now, I did this little research. These green lines are every time you've seen a large gain, which I denoted as a 20% move in the stock market index in a 63 trading day period. So it's a big gain in a 3-month window. That's what these green lines are. And then if you look 1 month out, well, probability of gain a little better than a coin flip because they do get some digestion after those very long big gains in short periods of time. But, and this is key, often after large gains, folks think, well, I missed it. I missed the rally. Well, I got to wait for it to come down. And in fact, it's the opposite, is the rally just getting going. Because you can look 6, 12 months out, often there's additional gain. Probability of gain is much higher than average after that long push off the bottom. So you get a big thrust off the bottom. That usually means you're at the start of a bull market, not the end of a bull market. But short term, you get a bit of that choppiness, a bit of that digestion. This just happened again. You can see these lines here that are far more recent, but we think it'll have likelihood of repeating what you've seen historically there, which is choppiness near term, but longer term gains. And then all of this is kind of coinciding here, Kevin. You talked about it, seasonality. You have rate cuts near all-time highs. You have strong gains in a short period of time, which often have some digestion. All of that is kind of taking place at a seasonally weak time in the market. This chart here speaks to that. This is from RenMac. I'll move our faces out of the way here so folks can see. It is, in fact, from RenMac. And what they're looking at is the U.S. market going all the way back to 1928. And they're looking at forward 3-month returns. So the low point here is at the beginning of August. So the forward 3 months would be August, September, and October, which seasonally tend to be weak. And that's really the whole point of the chart, that on average, that is the weakest time of the year. And you're seeing rate cuts near all-time highs, big gains in a short period of time, followed by digestion. All those are kind of lining up with a seasonally weak period. That's kind of our thesis, that we do have a very strong bull market, but entering perhaps a pause or a period of digestion. But we think there's still more gains to come after that.
Yeah, I mean, if we want to take a look out past this sort of August, September, October timeframe we're looking at and go to that sort of November through the end of the year and into 2026 early, what we're basically thinking is we said both the Bank of Canada and the Federal Reserve, which both meet in the middle of May or middle of September this year, should I say, are expected to make rate cuts. Now, are they looking at a quarter point, a half point? At this point, we're not sure. We are expecting more of a quarter point rate cut, wanting to be on that side, but anything's possible. We do continue to see tariffs being one of the main themes going forward. Again, whether there's any sort of a judicial precedence in the U.S. for how they're done. But we do see that tariffs will, even if it's on individual securities, sort of steel and aluminum like they've done, or looking at copper as opposed to a broad-based tariff, we do believe that's going to be in place as well. And it's more likely that deals are going to come along in the near future. That's one thing we're going to see. But one thing that we have to really worry about is, where is that inflation possibility going to go with tariffs? Now, this is a chart we see. Goldman Sachs did some research and published it, and it was reported by Thomson Reuters as well as CNBC, based on what they think the tariffs are going to look like from June and where they're going to be at the end of the year. As we saw early on, what we found, just based on this chart, is foreign exporters, well, they're absorbing some of the cost themselves. The U.S. consumers only actually had to pay roughly 25%, a little less than that, of what the tariffs look like at the moment. But what we're seeing is that with the U.S. businesses, 65% roughly are absorbing the cost of these tariffs at the moment. I think a lot of that has to do with the fact that there was a lot of product bought before tariffs were enacted, and that's going to run right now. They're not really having to pay anything. But come the end of the year, the margins that these companies make, if they continue to absorb, they're not going to be making profit at all. And that's just not going to be something that's sustainable. So yeah, you're probably, based on this chart, going to see a little bit more foreigners taking some of it. But basically what's happening is the U.S. business is shifting it all to the U.S. consumer. We expect over 65%. We don't. This survey, should I say, predicts over 65% of U.S. consumers will be paying the tariffs going forward. And that could definitely be very inflationary for how that's going to deal with. And that could have a big effect on whether we get rate cuts or possibly even rate increases.
Yeah, and again, this is an expectation from Goldman Sachs. So if the numbers are slightly different, that's certainly possible. They're trying to make a forecast, but we believe they're directionally accurate, that there could be more inflation passed along to consumers as these tariffs are kind of worked through. And what would make us change our mind? We went through kind of our view longer term, big bull market trends. We like all that. We think it's going to continue, but with a near-term pause. How do we know that near-term pause isn't a larger drawdown? How do we know when the pause is over? All those kind of questions. We got a few guideposts here to help us determine when our thesis is wrong and when we have to change our mind. And one is going to be a change in trend and deterioration in breadth. That we talked about all the big breadth we're seeing within the market and also globally. It's not just one market going up. You're seeing across the board. All that is positive. If that changes, we definitely have to change our mind. Tariffs. You mentioned some deals happening, maybe some inflation, more so being passed along to the consumer. If that's like a one and done, they figure out some deals and then tariffs are kind of set. And I think that's largely the expectation of the markets right now. Probably not too big of an issue. If they're constantly tweaked and adjusted, I don't like what that person said, we're up in the number, lowering the number, that creates more uncertainty. That would create more turmoil in our opinion. We'd have to revisit our thesis if that were to happen. Same with interest rates. We're expecting incremental, small moves. If you start getting big moves, that could be an issue. Inflation, Kevin mentioned, we do expect a little bit of a bump. That could be one time. If tariffs are kind of set, you get a one-time pass through, and then inflation can mitigate from there. If it actually starts re-accelerating, well, then you have to revisit your rate cut thesis and your overall idea here. So there's a few points we got to closely watch that would make us change our mind. As a recap, as we kind of conclude here, we do expect the bull market to continue. We are seeing uptrends. We are seeing lots of breadth, lots of positive movement there, but likely a few things pointing to near-term consolidation before additional gains. And we have a few guideposts of things we need to watch to make sure we're on track and we don't need to change our mind. If folks have questions, by all means, they can call us, they can email us, or you can go to chatwithclintonkevin.com if you like. On the screen there, chatwithclintonkevin.com. Lots of ways to reach out, but we'd certainly love to hear from you and are happy to continue the conversation. Take care.
Take care.